Welcome to another episode of On the House with Spartan Invest. Today we've got a special guest. He's joining us from Spartan Invest. It's Danny Cole. He is one of our wealth advisors. He works closely with a lot of our potential investors to identify their real estate choices, what properties they would want to move forward with, and really helps break down all of the benefits in purchasing real estate. So thank you so much for joining us, Danny.
Yeah, glad to be here. I'm excited to chat again. It's been a while.
I know it has been a minute. So you've been on the podcast several times, but really quickly, just kind of give us a very high level, a little bit about you and what you do.
See, I've been with Spartan as an investment consultant since 2019, which is hard to believe. The years have flown by. Yeah, and like you mentioned, I just love helping customers. The education piece is a big deal to me, like
Mm-hmm.
helping to just dive into the weeds and find something that they're looking for. I always say, hey, if they're looking for a unicorn, letting them know what a unicorn is and that, that doesn't exist. I'm sorry, and basically keeping people grounded and helping them
Mm-hmm.
understand that this is a long-term pension builder for them. And yeah, so been here a minute, but looking forward to many more.
Well, and that's the point of today's podcast, really. It's just more from an education standpoint or educational standpoint in regards to tax deductions, tax write offs when you're purchasing real estate. Now, we talk a lot about the benefits of purchasing any type of real estate, but your tax write-offs are a very large one, and we're getting towards the end of the year. This is usually when we see a lot of investors crank up. They kind of know what their tax liability is for the year. They're wanting to offset some of that. So talk to us a little bit about your depreciation. We spend a lot of time talking about appreciation, but talk to us about the depreciation side in real estate and some of the tax benefits.
Yeah, depreciation is one of the huge benefits that sometimes can be far overlooked when it
I
comes to real
agree. I
estate
agree.
investing.
We talk about so many of the other benefits like cash flow and your appreciation, and they're all valid. But yeah, depreciation does seem to get swept under the rug a little bit.
Absolutely. So, in a general sense, depreciation can be taken against the property itself. So, if you just round numbers, you've got a $100,000 investment, you've got an $80,000 valued home, and there's multiple ways your accountant can give that home itself its value because the land can't be depreciated. But you take that for residential purposes, not commercial, because it is different. You can depreciate it on a 27 and a half year basis. So basically, simple math, take your 80K divided by 27 and a half, and you can take that amount each year to write against your income. Now, normally what that does is your passive income is written, the depreciation or losses against passive income are against the income itself that's produced by that rental property, not your W-2 income. And we'll dive into that in just a little bit, but yes, it kind of helps offset some of those earnings that you would incur each year.
So talk a little bit more about that if you wanted to write off against your W-2 income and not necessarily the offset of the cash flow.
Yeah, and first of all, like I don't want to underestimate the ability to write off strictly against the cash flow of your rental properties because at the end of the day, the goal is to build a pension for yourself. It's to build more cash flow over the years. It's not a get rich quick scheme of any kind. So as you build those property or the income for those properties up, that those losses that you take as far as depreciation and write-offs against taxes and management fees and all that, even if you're not using that income right now, it lasts with that rental property. And even if you sell that property, you can write it off against that property at that time. So don't look at it strictly as, oh, I can't write it against my W-2 income, which is a huge misconception for many. But you still do get a wonderful gain against that passive income or rental income down the road. But I do have a lot of customers that want to know, okay, what do I need to do to write against my W-2 income? And there's several steps involved. If someone makes less than $100,000, and that's an AGI or adjusted gross income, they can write off losses from their passive income against W-2 income. And that AGI is, it doesn't matter if you're jointly filing a spouse situation or single filing, it's a flat $100,000. So if your AGI is less than that, then $25,000 can be written against your W-2 income. Now, as you go up, it goes between 100 and 150,000. Every $2 gained in income, W-2 income, in that AGI, you lose $1 worth of write-off. So that 25,000, for instance, I made 125, it would be 12.5 that you could still utilize against your W-2 income. So that's a pretty simplistic thing. So what you have to do to be able to do that, you do not have to be what's called a real estate professional by designation. You can just be a general, hey, I'm an engineer or whatever that may be, teacher, anything across the board. But you do have to what's called actively participate in your rentals. And that doesn't mean that you manage them. That can be another property manager on a day-to-day basis. But you actively communicate with them on rent increases, maybe big items such as a move out. You approve those items. And so from an IRS perspective, it's not a very big hill to climb.
Right.
But if you want to take it to the next step, that's where basically you can write off any amount of losses against rental income against your W-2 income. But that takes a lot of work. It takes what's called a real estate professional designation. Now, there's a lot of misconceptions around this. And I'll try to unpack it as best I can. And again, I want to tell everyone I'm not an accountant, don't want to be an accountant. So refer to your accountant when you speak about any of this. A real estate professional designation is a wonderful tool to use to write off against your W-2 income. And let's use the individual, they're making 500,000, okay? And so they need a tremendous amount of write-offs in any way they can get it. Well, to achieve that, if you or your spouse, if you file jointly, either or can have the real estate professional designation, which is great. So you can have your W-2 income and your spouse can meet two requirements. The first requirement is saying that 750 hours per year can actively be documented that they work in the real estate industry. And that could be lease management, that could be contracting, that could be developing. There's a number of ways you can get that designation. The other big thing, which does catch a lot of people off guard, is that it's the 50% rule. So for instance, let's say somebody manages their own properties and they can easily account for that 750 hours because they manage their doors. And it could be 5, 10, 15, 20 properties, but they're an engineer by trade. So most of their hours are in that engineering field. So they can account for the real estate portion being more than 50% of the income or time, I should say. So that would discount their real estate professional designation.
Right.
Does that make sense?
Yeah, absolutely. In the first scenario that you discussed, you're absolutely right. Like that is not a hard that's not a hard hurdle because all of those communications investors are already doing. You're already having those conversations with your property management company in regards to what's going on with your property. So that threshold is extremely low. The second example, it's a lot harder hill to climb in that it's really hard to have a full-time job outside of your real estate profession.
Yeah.
Talk a little bit about kind of what that timeline might look like. I mentioned earlier that it's towards the end of the year, but I mean, are you still able to generate the tax deductions? Does it matter when you purchase the property? Talk about the timeline for our listeners.
Yeah, absolutely. So the wonderful thing is let's dig into an example a little more. You've got someone that does meet the criteria for the real estate professional designation. Now, one thing that you have to keep in mind is that you do have to materially, per an IRS term, materially participate in your rentals to get that W-2 deduction or the losses from your rentals against your W-2 deduction. And that is, again, a bit tougher hill to climb because you have to show that there's just a lot more participation involved. Now, one way I've seen other people overcome this is let's say they have 5 properties being managed by Atlas Rental Property, and maybe be 10 or 15 for that matter, because they don't want to actively participate in a lot of things. They're looking to build a pension. They're looking for passive investing, right? That's what we do best. Well, they can, as they say, you can have your cake and eat it too, in a sense. So you can have those 15 rental properties through Atlas Rental Property. Unfortunately, that wouldn't allow you to write them against losses for those properties against your W-2 income, even if you have the real estate professional designation, because you're not participating enough. But you can, by an IRS term, you can lump all of your rental properties together and have a single property that's in your backyard, back door, somewhere close. It could be a short-term rental, it could be a long-term rental. If you manage that actively, that one single property, it can account for active participation against all of your properties. So no, you don't actively manage 15, 20, 30, it could be any number, but you can account for that one property. And that allows you to write off all losses against W-2 income if you have that designation, which is huge. And like you ask about timing, buying on the 11th hour of the 12th month is, still accounts for those write-offs. And again, I definitely don't want to detract someone from thinking like, oh, well, I can't write off against my W-2 income because I'm an engineer and my wife's a nurse or something of that nature, and we just can't meet that criteria. That's okay. Your goal is never going to be, or shouldn't be, just about the losses that you can write against W-2 income, because those losses carry forward against that rental income. And if you're doing it the right way, if your goal is to create a pension, if your structure is set up right, then you are going to increase your income, and you will need those losses in the future. You just will. You should. Mm-hmm. So, and again, you take appreciation and you take other factors. If you sell that property outright, that could be another big benefit. Now, I'm going to dig a little more or a little deeper one more time, and we'll go down the rabbit hole just a little bit more. And so let's say that you are a real estate professional by designation. And let's say that you can definitely write off against your W-2 income. You're already set there. You're good to go. One of the things I've seen people do to offset very high amounts of W-2 income is they'll use cost segregation studies. And if you don't know what that is, there's, again, a lot of misconceptions around it. Mm-hmm. But they basically, in very layman terms, they'll take a property, and it can be a brand new house. You don't have to renovate it. You don't have to do anything to it. You can buy it just as it stands in 2025 built homes. But they'll take that property and they'll depreciate everything, but basically the structure, the roof, and everything like cabinetry and maybe windows and blinds and everything. And they'll give it a different number for depreciation. Well, with the new Trump changes in the tax law, you can write off that year one depreciated amount from the cost seg study in full. You don't get a 60%, 40%. You can do 100% of that. So again, going back, go ahead.
So sorry. I just wanted to interject and let everybody know that if you want to learn more about cost segregation studies and how they're to be performed, in episode 104, we had a representative, Richmond Stecker from USA Cost Segregation, on to the podcast, and he went into a deep dive about that. So if you want to reference that episode as well. So sorry, I didn't mean to cut you off, but keep going. I just wanted to give people, our listeners, just an outlet to learn more.
No, that's perfect. Thank you for that, because again, you can get into those granular details with him, and he, of course, understands it better than any of us. But with that cost seg study, it's nice because you can take, let's say, a $300,000 home. It's new construction, and you want to accelerate your losses against W-2. If you do that, let's say it was $80,000 in that cost seg study that you can use in year one. Well, you can write that against your W-2 income, which is huge, but you still get the normal depreciation from that property. So again, you take a $300,000 property, let's say 280 of that is a depreciable asset, the home itself. So you just deduct that from 280, take the 80 away, you've already taken. And so if that was a little over $10,000, roughly $200 a year, based on 27 and a half years that you would have taken, you get $80,000 up front year one. Now, if you're not going to use that money, if you're not going to deploy that money, if it's not going to be a huge savings for you from a tax perspective or an investment perspective, it's the time value of money. That's where cost seg studies work out well. But if you're going to put it under your mattress and do nothing with it, you're just wasting your time, in my opinion. A cost seg study is great, but you have to put that money to work, because there is a recapture if you sell that property, if you don't 1031 exchange it. But so again, there's a lot of ways, not to bore everyone, to benefit from depreciation and tax savings but it does depend on your situation whether or not you can write against W-2 income.
Yeah, I think your cost segregation studies or your cost segregation tool is extremely beneficial for those investors that are the end goal is to buy and hold, and they really want to offset maybe a higher earnings year. We've seen that with investors, especially over the last few years. Is like, hey, look, my tax liability, it's increasing. I'm going to go ahead and do a cost segregation study so I can reduce kind of this year, knowing that I'm going to have to pay it off. But my goal is to just stay in the real estate game, is the buy and hold. So I'm just going to hang on to this. And then in that case, you wouldn't necessarily be responsible for it. And if you used a 1031, if you stayed in real estate. What else?
Absolutely.
What else can you share with everyone? Like I said, end of the year is usually when we see a pretty big spike in investors, especially on the new construction side. So what else would you want listeners to know about capitalizing on these tax benefits?
Yeah, so another one that we haven't talked about, and I do a lot of 1031 exchanges toward the end of each year and throughout the year for that matter, because you can't always time it in that way. But a 1031 exchange is just a great way if you're selling a property in a high appreciation state and looking to capitalize or utilize more cash flow on a monthly basis. Spartan Invest is really good at that, helping you with that, setting you up with a great intermediary and actually putting your money to work versus there's so many customers I have that their money is just sitting kind of idle. Yes, they've appreciated. That's wonderful, but the money's not doing anything for them on a day-to-day basis. So that's just a wonderful way, especially right here at the end of the year. If you don't want to pay all those capital gains, roll it back into something that works for you. And I would be happy to talk to you more about that.
Absolutely. Well, thank you so much, Danny, for joining us today. If you want to learn more, if you want to reach out and speak to Danny, visit us at SpartanInvest.com. And that's On the House with Spartan Invest.